So I'll make some introductory comments about the discussion paper from a WAG perspective. Then Greg will do a relatively in-depth dive through the work that they've developed, and then we'll have an opportunity for questions and answers at the end, so maybe save those up for later. But just to introduce myself, my name's John Hancock. I'm the chair of the Wholesale Advisory Group, and the members of the WAG are on the screen at the moment. The theory was that we were going to get some of the rest of them to come and co-present this with me, so you'll note that there are no other members of the Wholesale Advisory Group currently in Wellington. But I think we might have a couple on the phone. Now, Alan Eyes was rumoured to be on the phone, but is being very silent. Is there anyone else from the group who's out there in the ether somewhere? But just to explain, so we've got Philip Anderson's an independent sort of speculative trader. Neil Barclay's the GM of trading and production at Meridian. John Carnegie's the energy and climate manager at Business New Zealand. Graham Everett's the energy manager from Norske Skog Tasman. Alan Eyes is the energy manager at New Zealand Steel. Chris Jewell's the portfolio manager at GM at Genesis. Stephen Peterson runs Simply Energy, new entrant retailer with a twist. Bruce Rogers as the commercial manager at Orion, Lions business in Christchurch, and Richard Spearman's the operations manager at Trustpower. So the Wholesale Advisory Group is reasonably diverse. The idea is that we balance sort of supply and demand side interests with a couple of independents. So and just for clarification, a lot of people aren't quite clear about the relationship between the two advisory groups and the Electricity Authority Board. So the Electricity Authority, unlike the Electricity Commission, has two advisory groups which are independent. So the work programme for the advisory groups is dictated by the Authority Board, but the work of the advisory groups is independent, which is to say that the groups can say what they want, and it creates an interesting tension between the authority and the industry, really, that the authority board isn't bound to follow any of the advice from its advisory groups, but it would be a very odd look if the advisory group spent 6 months looking into something and the board completely ignored what they came up with. So that's the sort of deliberate design tension here. So in terms of process, the authority board, actually I've got a slide on this, haven't I? The Authority Board requested the Wholesale Advisory Group to make a sort of general investigation into the opportunities for further developments for electricity hedge markets in New Zealand. And the request was quite loosely worded, and that was quite deliberate on the board's part. But obviously it's a sort of fairly key tactic to particularly facilitating retail new entry, which is a very high priority initiative for the authority themselves. But it's very much been for the WAG to sort of do its own sort of a condition assessment and problem definition. So we don't always put discussion papers out to the industry. Close industry watchers may have noticed that there's been a spate of national market investigations recently, and I think where we've got to with all of those is that they're sort of no-brainers, really, so there's very little point going to the industry to discuss these issues, and we've directly recommended the sort of progressing those markets in our advice to the Authority Board. The reason that we haven't discussed that with the industry is that every time the wholesale or retail advisory groups discuss stuff with the industry, it adds about 6 months to the timeline for a project. So if something's a good idea, you might as well just get on with it. The board itself, even if it accepted any of the advisory group's recommendations in their entirety, still has a statutory obligation to consult. So even if they decided to pick up our final report and codify everything in it, they'd still have to go back to the industry and consult on rule changes and stuff. So there will be another opportunity for the industry to interact on this, but you'd be interacting with the authority board and the authority's bureaucracy rather than with a sort of more sort of a diverse group, which is what the advisory group's intended to be. So there's no guarantee that anything that you represent to us will make it into rule changes at the end of the day, but if you can present us with more information and more evidence of what the actual problems with the hedge market are, and once we've clarified those, what could be done about it and why, it's more likely to influence the development of the code in New Zealand. So that's the sort of process that we're following here. So specifically on the hedge market development project, I think if you look at the slide that we're beaming up, there's a sense that certainly in terms of the ASX index, there's been considerable progress in the evolution of that hedge market, and I'll put up some other details from the discussion paper which point to developments in the over-the-counter market as well, where there's some evidence that participants are quite pleased with the evolution of those markets as well. And there's an interesting discussion in the discussion paper about the nature of hedge markets and the role that hedge markets in a broader sense play in risk management for electricity in New Zealand, and the nature of the risks that need to be managed and the role of hedge markets against them. But we shouldn't forget that some participants have become more sophisticated in terms of their physical risk management strategies, which obviously isn't hedging in the commercial sense, but it's another mechanism by which these risks can be managed, and it provides a bit of context for the discussion. So just looking at what's been going on, one of the sources of information that we were quite lucky to be able to influence was the annual survey that the Electricity Authority makes of market participants, and we deliberately introduced a bunch of questions to this year's survey about hedge market performance. So the results of those questions are included in the discussion paper, but it's quite interesting to track the evolution of participant opinions about the competitiveness of the hedge market. So the slide that I'm showing at the moment shows how industry participants rate the competitiveness of hedge markets in New Zealand from the first time that the Electricity Commission did this survey right the way through to this year. And there is definitely a trend towards participants being more satisfied with the competitiveness of hedge markets. But to provide a little bit more colour about this, we invited some participants with particularly strong perspectives or particularly strong positions in the market to come and brief the advisory group on their perspectives. So we had presentations from several independent retailers and generators, given the interest the authority has in facilitating new entry. We had a presentation from ASX themselves. It's quite interesting, particularly given their insights around the evolution of other listed exchange-based markets. OMF as a broker, one direct purchaser, and I suppose the other thing is we've done quite a bit of analysis, all of which is included in summary form in the discussion paper and in a wealth of detail in the 350 appendices that we culled from the main document to make it slightly more readable. There is also a summary of the presentations that we had from the various market participants, which has been approved by them for release. So if you're interested in the perspectives of some of the people who are quoted in the paper, you can go and see what they actually said to us, which may be of some interest. One of the assertions that several people have made, Pulse in particular, are that premiums in the ASX are far above forecast spot market prices, and Gary Holden actually put a number on that for us, which is pretty exciting number if we can actually prove whether it's true or not. And certainly the results of the hedge market survey do suggest that some participants are less convinced about whether prices in the ASX are competitively determined or not. And I think one of the most important things for this discussion paper is to try and flash out more evidence and analysis to either prove or disprove that, and then come up with a clear problem definition against which we could make recommendations to the authority board. I suppose the other area beyond price is around liquidity. One of the responses that we got to the hedge market survey suggested that approaching counterparties directly is obviously a great way of doing business, but it's not a great way of doing business if 9 out of 10 times they don't actually offer you anything in return. And certainly there have been some reasonably high-profile examples which some participants have used the media to draw attention to about where they've gone to market and just not been able to get any responses to tenders they've been running, or only receiving responses at prices that they weren't prepared to contract against. So again, there's a bunch of detail in the paper around liquidity and what analysis we've managed to do on whether there really is a problem with liquidity in the various hedge markets. A third area that we've given quite a lot of attention to is around barriers to participation. And I suppose to summarize the concern there is that the electricity industry is pretty flipping complicated, and the hedge market applies a whole set of complication on the back of what's already a very complicated industry. And even with some reasonably expert participants, we have had some feedback that it's extremely difficult to understand the risk management options that are open to them, given the complexity and the way in which information around the performance of those markets is currently presented. And it may be that quite a non-distortionary set of initiatives, which would be relatively easy to implement, would relate to the transparency and comprehensibility of some of the hedge market instruments that we have, rather than necessarily design changes to them. So again, we're quite interested in trying to flush that out. So in the discussion paper, we cover those issues, and there is supporting analysis, as I say, behind them. But to really summarize three of the key areas, we're very interested in the nature of price risk, and in particular how those risks can be managed and the extent to which prices in the hedge markets reflect the fundamental nature of the risks that they are monetizing, if you like. The second one is around the role of vertical integration to manage risk, and the impact that that has on liquidity, and the extent to which illiquid markets are a barrier to participation, and the consequences of that. And then, God, it almost sounds like we've been drinking from the cup of behavioral economics. The limitations in time, resources, and interest. So this is bounded rationality. People are busy people. For many people in the industrial sector, energy is not their only procurement concern, and it's only for the very, very largest energy users that they have dedicated specialists. So for the ones who don't have dedicated energy procurement specialists, is there a limit to the amount of time they can spend on this? And is that preventing them from participating as fully as they might be able to? So it's pretty rich stuff. I think the paper, I got it down to about 80 pages, but if you read all the appendices, we're right up into about 350, so that's pretty good fun. And one of the main reasons it's such a weighty piece of work is that we commissioned, well, through the authority, some work from Energy Link. So Greg Size, who's the managing director of Energy Link, is here to talk to that analysis. But just to explain a little bit about where this request came from. So we did ourselves some backward-looking analysis, which did suggest that there is a difference between average futures prices and average spot prices. But we acknowledge that spot prices are strongly influenced by current conditions. So what's a more interesting piece of analysis is a difference between futures prices and a range of possible future spot price outcomes. Yeah, so we're getting the time consistency between the two. Everybody has some views on future spot prices, and nobody is prepared to share those views because obviously they're commercially confidential, and if you're a major trader, that's part of your competitive advantage. So we asked Energy Link, who provide a widely used and widely disclosed set of forecasts of the spot market, whether they'd be able to run some simulations around spot price forecasts based on their own proprietary model, but at least a proprietary model that they don't use to trade on their own account, and futures prices, and then hopefully provide a little bit of context in terms of what the differences between the two are, and what that might lead us to conclude about hedge markets. So that's my segue into Greg's presentation. Greg will probably spend about an hour, I think, going through his slides, maybe a bit less. And then my suggestion is that we then have a Q&A on the energy link analysis, and then I'll take the microphone back, and then we can have a more general Q&A about the WAG process and the rest of the discussion paper, if that's all right with people. So I'm sorry it's all a bit one way, but it's good stuff. So Greg, grab the microphone, and hopefully somebody is going to get your slides up.
Thanks, John.
We can hear you.
Okay, well, welcome everyone who's dialed into the teleconference, and anyone who's on the webinar.
So I gather Alan Eyes is one who was on the...
Right, so if there's any really difficult questions about some of the more politically pointed comments in the discussion paper, I'll just get Alan to talk about those, because I couldn't possibly be dragged into anything controversial. Right, have we got Greg's slides?
I think the line will be breaking up by then, John.
We've got quite a lot of exciting strobing screens behind us in Wellington. You could start talking, actually, couldn't you, Greg, and maybe introduce the nature of your model and stuff like that while we're getting the slides going.
Thanks, John. Well, my job for the next 45 minutes, hopefully not much longer, is really to take you through the two papers that we wrote for the WAG, and not too much detail. So I'm going to focus on the key points, and I'm sure we can cover any missing pieces during the Q&A. Before we do that, I just want to run through what a delta actually is, just so that we're all absolutely clear on this, because it can be a little bit confusing. So what is a delta? Delta is a Greek symbol that is often used in mathematics, physics, etc., to indicate some sort of a difference. And the difference that we're interested in is the difference between a futures price and the expected spot price for the relevant period. So if we're talking December 16, for example, expiry, the price, I checked this on Friday, was $60, and I might expect the spot price in December 16, for whatever reason, to be $70. So at least from my point of view, the delta as of today would be minus $10. Okay, so it's a simple concept, but it can be relatively easy to get confused when you're reading reports or doing analysis because of the timing issue. So we have to be absolutely sure that we're matching the futures prices up with the correct period. And the next thing I want to talk about is, well, what does this expected spot price mean? It means different things to different people, I guess. It is either a forecast or a guess, or maybe just a gut feeling based on experience of what the spot price is going to be at some point in the future. In our case, we're interested in the average price over a particular quarter. Of course, spot prices are hugely volatile, as we know. Various people have told me from the banking industry, for example, investment community, that the most volatile commodity prices they get involved with, which means it's almost impossible to predict spot prices exactly. So what we mean by expected spot prices is typically a range, which we might draw from past experience, for example, or in my case, being a modeller and a forecaster, from our forecasts, and we'll take some sort of an average across that. And this gets particularly important when we look further into the future, because obviously there's less and less certainty the further out that we're looking. There's a big problem with this because we can't directly observe expected spot prices. We can only look backwards to see what prices actually were. So talking about looking backwards, then this is the approach that you'll find in the academic literature when researchers look at deltas, or what they usually call premiums, in futures markets. And this isn't just electricity futures, this is futures markets in general. So what they're looking for is a large sample of data from the past for spot prices. In our case, it would be quarterly average spot prices. The larger the sample, the better. Obviously, the more data you've got, the more statistically significant the analysis might be. So just in very simple terms, if we were looking at the futures price in blue and the average spot price for the quarter in orange, and if we found that even though they didn't match up exactly at any particular quarter, on average the difference between the two was zero, we might conclude that the delta was zero. Likewise, if the futures price tended to sit above the spot price, as it actually turned out, we might conclude that there was a positive delta. And we also find negative deltas as well, where the futures price may tend to sit below the actual spot prices for the relevant quarter. Now, the other thing we have to be very careful about here is the time frame that we're looking at. Now, futures prices for electricity converge to the actual average spot price for the quarter consistently. If they didn't, there'd be an opportunity for risk-free profits arbitrage. So we have to be very, very careful about the period that we're looking at. How far ahead into the future are we looking? So in this particular example, hypothetical deltas for December futures, and this is the sort of thing that we looked at for both of the reports that we did. So for example, in December 09, that's the first delta. We're comparing the December 10 futures price as of December 09 with the actual spot price for average spot price for the December 10 quarter. Obviously, we couldn't do that until after the 31st of December 2010. And as we move through time, we could look at the December 11 quarter in 2012, and we would be comparing the December 11 futures price as it was in December 10 to the actual spot price for that December 11 quarter, and so on and so on and so on. And what we've done in some of the analysis for the reports was to look at that premium over time, up to 50 months ahead of time, because that's about the longest time that any particular futures contract's been trading. Now, I've got to put some caveats in on this analysis because what we were originally asked to do in the end was to come up with a statement as to whether the deltas were risk premiums or not, and whether they were if you like, the theoretically correct values given our market. And unfortunately, it's just about impossible to do that. The debate around premiums and futures markets in general, so not just electricity, futures for hogs, bellies and wheat and heavens knows what else, has gone on for decades and decades, and it continues to do so. Relatively little literature concerning electricity futures, but definitely enough to start showing a trend, which I'll talk about later. And of course, there's many factors that potentially affect spot prices, and some of those also potentially affect the deltas that we might observe in electricity futures. So structure of the spot market, for example, I found one paper that talked about different characteristics of deltas between the thermally dominated electricity market versus a mixed hydrothermal market. Liquidity has to have a big impact, and I think it's relatively easy to see that the more liquidity there is in a futures market, the more likely that the observed deltas would be efficient, if you like. Volatility of the underlying spot price obviously has a big impact. Perceptions of risk, I think, is very important. I'll talk about this later, how traders in the futures markets may see the risks and how different traders may see different levels of risks. As the market matures, hopefully the deltas become more and more efficient. We certainly saw in our analysis that if we went back prior to 2000, we got results which were quite at odds with the results that we got from 2000 onwards. So we've tended to limit our analysis to 2000. Now that's not in terms of the futures market, obviously, which has only been around since December 2009, but in terms of comparisons between spot prices and futures prices, which we'll look at later. Access to information, this is the asymmetric information problem, and it certainly has an impact, or has had an impact in the past. We've got better information available to us now, so maybe that's not as much of an issue as it has been. And there are obviously other factors which could affect the deltas that are observed in the futures market. So the point I want to make here really is that there are all these things going on in the background. We, EnergyLink in other words, may or may not know about those factors, particularly in the case of individual futures traders. So it can be very hard to come up with really good explanations as to why deltas may appear in futures prices. Now, as far as I can tell, there's virtually no academic literature, at least, which uses forecasts to analyse deltas. So the work that we've done for the WAG, I guess, is potentially groundbreaking in a way. Most of it focuses on historical analysis. And there's virtually no literature on determining how you might actually go about working out what the most efficient delta should be in futures markets, particularly electricity futures markets, which obviously haven't been around that long. Okay, so I'll just quickly run through our overall conclusions, just to set the scene if you like, and then I'll come back and take you through our analysis step by step. So one thing that is pretty obvious from the evolution of futures and the hedge market in general, thinking about the over-the-counter market, which has been around since 1996, if not a little bit earlier, and that is that hedge prices in general do follow expectations of spot prices. Now there may be deltas quarter by quarter, there may be average deltas over a whole year, for example, but for instance when expectations of spot prices fell quite significantly around about 2011, 2012, we saw quite a large drop in the over-the-counter and the ASX prices, around about $15 to $20. I could talk about examples further back as well. If you look at our market and electricity futures markets around the world, based on the literature that we were able to find, they tend towards being in what's known as contango. I always like to keep the jargon to a minimum talking about futures and hedge markets because it can get confusing. But what that basically means is that a contango electricity futures market tends towards having positive deltas rather than negative deltas. Having said that, we certainly saw positive and negative deltas coming through in our analysis. I'll talk later about a technique for comparing returns or deltas in disparate markets. We applied this to the electricity futures here and in Australia. We were quite lucky to be able to easily access a long time series of data for the Australian markets, and we found that the New Zealand electricity deltas don't stand out if you compare them to the Australian electricity futures deltas. And based on published research, if we look at other commodity indexes and even things like treasury bonds and equities, the deltas that we observed don't stand out against those either. Definitely the South Island tends to have higher deltas than the North Island because of perceptions around hydro risk. And we can also say that the deltas in Q2 and Q3, which are generally positive, are a relatively well-established pattern in our market. Q1 and Q4 are less obvious, and it certainly had us scratching our heads to come up with reasons why we might see what we actually observed there. So, after a quick glass of water, I'll move on to talking about the specific tasks that we were given. So the work was actually separated into two parts, and the first part was to deal with task 1 and 2, and that was primarily about forecasting. As John mentioned, the WAG wanted a range of forecast scenarios looking ahead with which to compare the futures prices. So what we did was we took our base case from our July 2014 price path, which we published to a wide range of subscribers, and we came up with 9 variations on those. And the 9 variations were intended to cover a wide range of possible futures, possibly a confusing term there, possible future scenarios for the evolution of the electricity market, and particularly for the evolution of prices. For each of those 10 scenarios, so base plus 9 variations, we modelled 83 years of inflow data as well. So that's starting from April 1931 through to March 2014. And that modelling was carried out for the period to match up with the forward curve for futures. So July 14 through to June 18. December 18 futures have popped up there subsequently, but they weren't available at that time. This was all done back in September, October. Seems a long time ago now. So 830 scenarios in total, and out of that we certainly came up with a wide range of possible future price paths, and consequently a wide range of possible deltas. And the second part of that work was to comment on any premiums evident and whether we could see any patterns. Now, I'm just pausing because the slides aren't quite in the order that I was expecting. Never mind, we'll box on. So I'm actually jumping back here to the historical analysis. So this is looking backwards, and I've got two charts, one for Otahuhu and one for Benmore, and we're looking at it actually says error on the chart. That's my mistake, it should be delta. We're looking at the deltas on average in our futures market relative to the relevant spot prices from the earliest contract, which was July 09, through to the July 2014 contract, which just expired as we started the work. And what we can see is that we've got a very strong trend towards positive deltas. So 3 of the quarters in both islands, Q2, Q3 and Q4, show predominantly positive deltas. There's a bit of an outlier if we head to the left-hand side of the graphs. Q2, for example, it starts off with a small negative delta and then it jumps up to a large positive delta, possibly due to a little bit of inexperienced trading in the early days of the futures market. But predominantly the Q2 contract is quite significantly positive in terms of delta until you get close to expiry, where of course they all converge down to the actual average spot price and the delta disappears down to 0. Q4's got a little bit of a mix. Up at Otahuhu, for example, it's predominantly positive, but around about 12 months out from expiry of the relevant quarter, it goes down to being negative. Also goes negative in the South Island as well, although only for the last 3 or 4 months. The standout, I guess, is Q1, which is consistently negative in terms of delta. We've had some pretty dry Q1s recently, which is the main reason behind that, and this along with some evidence has led us to an explanation of why we see the deltas in futures prices now that we do. Okay.
Maybe just tell people on the phone what's happening.
For those of you on the phone or on the web, we're just taking a short break while Tim Street hands some more handouts around the audience of about 20 gathered here today. Okay, so we're now jumping back to modelled scenarios. So a very quick jump through the range of scenarios that we looked at. The base case, we looked at one where now this refers to scarcity pricing. This is not scarcity pricing. It's in the rules. It's non-supply cost, if you like. Then a higher price scenario C with no response to high prices by industrial demand in particular, which tends to reduce higher prices. Scenario D looked at changes to the risk attitudes for hydro generators in particular, being more conservative into future, which tended to raise prices slightly above base case and alter the profile of prices across the year. We looked at what happens if you get more random outages in thermal plant in particular. Scenario F produced the higher prices. So as we all know, demand growth has been about zero since 2006, slightly negative even. So we looked at what happens if demand growth goes back onto the old linear trend that was even from 1974 to 2006. G is another low price scenario, so that's short run marginal cost offers right through the period. H is our lowest price scenario. That's on an assumption that the smelter closes forever January 2017. And then I and J are combinations of factors which might drive prices higher or lower depending on the case that you're looking at. Now this is where it's going to become really obvious that I'm not looking at the presentation that I thought I was, because there's an error here because where I've got positive deltas are actually negative and vice versa. So we're looking at a summary of all the scenarios, this time for Otahu. So those are the curves, the 10 curves, and the futures prices as of 1 July 2014 are the red bars. And if we look at June 18, for example, we've got around about 5 scenarios which are producing actually negative deltas. Now each of those curves is the average over 83 years of inflows. So we're not trying to present all 830 scenarios on here, because that would obviously be impossible to interpret. And likewise, where it says negative deltas, this is what happens when you do these things when you're half asleep late at night. You get them the wrong way round. Anyway, let's box on. We've got the same chart for Benmore. Now I'd just like to make a point about these red bars. Those are the futures prices as of 1 July 2014. So all of our analysis around the modelling was based on that particular date. And that begs the question, well, is there anything special about that particular date? Why did we pick it? And the reason is that there's nothing special about the date, and it was just convenient because it matched up with the date that we published our base case. So if we ignore what was happening in the front quarter, in other words the first quarter or the September 14 quarter at the time, pretty much what we're seeing was a relatively stable pattern that had been there for weeks or months. So nothing about 1 July 2014 skews the results, if you like. That's not to say that things haven't moved on since then, but that's probably a topic for another day. And I hope that these charts show that the range of scenarios that we modelled was quite wide. I hope that it also shows that there are some very obvious standouts. For example, December quarter, December 15. Obviously that's a negative delta across all of those modelled scenarios. And what we see in the December quarter is a very distinct tendency towards negative deltas across virtually all scenarios. Not all of them, but certainly the majority of them. Likewise, we've got positive deltas in Q2 and Q3. So in other words, the red bars in Q2 and Q3 protrude up through most of those scenarios, which is interesting because it tends to, certainly in line with what was observed in the historical analysis of the futures prices. So those two things match up quite well. Now, in Q1, the situation is not quite as clear. They're mainly positive deltas, but there's a couple of Q1s where there's either 0 or I think minus 2 delta. So the picture's not totally as clear for Q1. Just pausing while I think if there's anything I can add here at this point. I'm going to come back to the modelling a little bit later, so the points that I want to add are better made on later slides, which are again slightly out of order. But just to go through the conclusions to this point, having worked through the work that we did for tasks 1 and 2, so this was predominantly around modelling, scenario modelling, but with a little bit of a review of the historical prices as well. So looking backwards, we saw consistently positive deltas in Q2 and Q3, Q1 consistently negative, and Q4 was mainly positive but a little bit negative, at least on average. From the modelling relative to the futures prices on 1 July 2014, on average we saw positive deltas for Q2 and Q3. Q4 was negative, which is different to what was observed in the historical futures, and Q1 was mixed but mainly positive, and again that's quite at odds with what was observed in the historical analysis of the futures prices. Just a final comment here that even though there's a wide range of expected prices that came out of the modelling, that's not to say that any of those is particularly the correct one, and it's not to say that everyone agrees on that range being representative, and not everyone is going to agree that any particular scenario, let alone the base case, is more likely than the other. Okay, so moving on to task 3, which is where we were asked to try and put these deltas that were observed in historical prices and also through the modelling into some sort of a context, and as far as possible come up with some sort of a statement as to whether the deltas that we were seeing were consistent with the workably competitive market. So we looked at a number of different aspects. What happens in other electricity futures markets, and we were able to glean something from that. What happens in other commodity markets, that was interesting, if not quite so strong in terms of evidence. We looked at how liquid the futures market is and what impact that might have on the deltas. We looked at whether the deltas are risk premiums. In other words, are they an extra amount that a natural hedger would be prepared to pay and to avoid taking risk entirely on the spot price. And we also looked at what's known as hedging pressure to see if we could use the hedging pressure theory to explain how deltas might come about. And one of the things that we spent a lot of time looking at were the profiles that come from the futures market, from the modelling, and also from historical spot prices going back to 2000. And I mentioned that when you go back beyond 2000, prices behaved somewhat differently to what they have done since 2000. So we tended to ignore what happened prior to 2000. And what I mean by a profile is the shape of a curve across 4 quarters. So for example, if I've got 4 quarters, Q1 to 4, 50, 90, 85 and 45 with an average of $67.50, then the profile is expressed in percentages. So Q1 is 74% of the average, 133% of the average for Q2, etc., etc. So we're looking really at this sort of a graph. The futures prices in my example are the blue columns, and the profile values and percentages are the orange curve. I've got the average of around about $68 dotted across there. So we managed to glean quite a lot by looking at the differences and similarities and profiles between spot prices, modelling and futures prices. So we're looking at profiles for Benmore and for Otahuhu. The profiles for the market, the actual spot prices from 2000 through to 2013. For the futures prices, they're on the forward, from the full forward curve as of 1 July 2014, and then the same period for the base case only out of the modelling. Now the profile that we get from all of the model scenarios is pretty similar across the range of 10 scenarios. Not exactly the same, but pretty similar. So the base case is a good representative. And just focusing on the difference between what we've observed in actual spot prices versus what we see in the futures market, futures in blue, actual spot prices in black, we can see that there are some significant differences. In particular, the one that stands out is Q3. There's a big gap between the behaviour of spot prices by quarter since 1996 and what the futures prices suggest might be the behaviour of spot prices going into the future, the expected spot price. So just focusing on Q3, there's an issue here that being a modeller I think about just about every day, sometimes in the middle of the night. as I was last night, trying to remember all the slides, and that is that when we do our modelling with 83 inflows, that's all very well and good, but unfortunately the market's only been around for about 18 years. So the market has not had a chance to actually run through all of those 83 years of historical inflow scenarios. And what actually happens, or has happened in the past, assuming we can believe the inflow data that we have, back to 1931, is that there's been quite a number of years where the hydro lakes, particularly in the South Island, have remained very low right through till Christmas. 1976 is my favourite example because I happened to be standing on the original shore of Lake Hawea. The lake was that low, 60 feet below its normal operating level now, in the Christmas of 1976 when I was a lot younger. So 1976, 1937, 1931, by the time we're getting back to the 1930s, I do wonder just how accurate that inflow data is. Definitely not. So what I think is happening here is that certainly in the modelling we can prove this, but I think also in the futures prices, what we're seeing in Q3 is the impact of those. It's a bit like a Christmas carol. It's those inflows that haven't happened yet, but which could happen. Okay, so that I think explains why there's a big gap in that profile and a big delta observed in Q3 generally in the futures market. When I say big, relatively big. Okay, Q2 is probably the quarter where there's the best match-up. So we've had a lot of dry years in the history of the market since 2000, and you can see that quite clearly in the spike in the average spot price for Q2, and that seems to be reflected, certainly in our modelling it is, and it seems to be reflected in the futures prices as well. Q1's a little bit more difficult. At Otahu, there's not a big gap between what's happened in the market versus what the futures prices indicate, at least about the profile. But if we look down in Benmore, we can see that there's quite a significant gap between the spot prices and the futures and the modelling profiles. And I guess this is largely a function of the dry years that we've had, dry autumns that we've had in the recent past. Just to pick up an example there, the period from December 2011 through to May 2012 was the driest in the South Island on record by a country mile, by something like 10%. Almost unheard of gap between what had previously been observed and what happened in 2012. In Q4, we're seeing what looks to be a lower profile value in the futures prices than what's been observed in the market, and also in what we get in all of our modelling. So this is where we're starting to see the negative delta in Q4 coming through in both islands. So just to pick up on Q1, as time's moved on, and what we're looking at here are the futures price profiles on 1 July starting in 2010 and moving through to 2014. And what's particularly noticeable there is that the profile value for Q1 has been steadily increasing. Now this is Benmore. It's not quite as evident at Otahu, but it still happens. But particularly down in Benmore, and I think as a reflection of those very dry Q1s. And I should add here, whether or not Q1 continues to be dry in the future or not is an open question. I think what we're really talking about here is the perception that we're in a period where Q1 is relatively dry. And you can see that influence quite strongly, I think, on the profile value for the futures prices. Okay, now I want to talk about hedging pressure, and this produces some interesting results for us, I think. So the theory of hedging pressure is that when demand for a hedge exceeds supply, investors, and we'll talk about what investors means, will meet, or hopefully will meet, excess demand for hedges in return for some non-zero delta. Okay, so they're looking for a return on their investment in return for taking a risk on buying or selling futures. So if we've got an excess of willing buyers, then we'll tend to see investors selling futures, which in theory should lead to a positive delta, and vice versa. Okay. So who are these investors? Depends largely on how liquid the futures market is. So if it's very liquid, if there's a high degree of liquidity, then we can probably be confident that our investors are speculators, funds, intermediaries maybe that are trading in their own right, as well as providing some sort of an intermediation service in the hedge market. If the market is less liquid, and I think we also need to include natural hedges in the investor category. So this could be, for example, a hydro generator, and this is particularly relevant in the South Island, that has ended up with hedges or futures in excess of what they actually need to hedge during a particular period. So we've used this to look at a number of different ways of estimating what deltas might ideally be if the market was more liquid, because there are certainly signs that it's relatively illiquid at the moment. So we've looked at the incentives on market makers and some of the costs that might incur in the futures market with low levels of liquidity in order to provide a certain degree of liquidity through that market making. We've also looked at returns to investors from investing in futures, and this is where we've used the concept of the Sharpe ratio. And we've also looked into the literature to see what hedging pressure is doing to deltas in other futures markets for electricity around the world, and there are a few of them which have been running for some time now. Now, I don't want anyone to pick up the suggestion that I'm actually asserting that what I'm about to go through here is actually the case. This is hypothetical, if you like. It is backed up by a little bit of news that's come through on Energy News in particular regarding hedging strategies. But what we're talking about here is effectively the cost of hedging or providing hedge liquidity in the South Island. And the issue here is that in a dry year, South Island generators, who are predominantly hydro, may not be able to generate enough to cover their hedge portfolio, including futures contracts that they may have sold as part of their role as a market maker. So the other assumptions are that we've got a low level of liquidity in our electricity futures, which means that the market's relatively reliant on those market makers. And what we looked at was how a South Island hydro generator might cover the potential risks of being a market maker or providing extra hedges in a dry year. And we looked at that in the form of an option, or more particularly a swaption, which is an option to buy a swap contract at some particular cost. Now, without going into the details, we came up with a formula, if you like, which allowed us to estimate the cost of most of a unit of Huntly in the North Island being made available to South Island Hydro in general for the purposes of generation in a dry year to cover CFD, which would be picked up by South Island Hydro. And if the cost of that was spread over Q2 and Q3 only, which is where the predominant hydro risk is, then that could potentially lead to a positive delta of around about 6%, on the assumption that the cost of providing that swaption would be reflected through into futures prices. Now I'll move on quickly because I'm conscious that I said I'd get through this in sort of 40 to 45 minutes. And we'll talk about Sharpe ratios, which are widely used in financial markets to provide investors, fund managers and others with information about the performance of particular investments or, in our case, futures markets. So what I want you to do is imagine that you're an investor and you've got the choice between two different investments with slightly different outcomes. They both return 10% on average, and when we do these exercises we need to specify whether we're looking at 10% per annum in this case or monthly for the best analysis that we could do on the futures market. So 10% per annum, they're identical in terms of a risk neutral perspective, but one of them has a standard deviation which is significantly lower in terms of the annual return than the other. Okay, so the Sharpe ratio is an easy way of determining for an investor which one they might choose, all other things being equal. Now the other thing we need to add in here is that we need to have some sort of a benchmark investment, and something close to the risk-free rate is typically chosen. So we'll use 3% per annum with a low standard deviation of 1% per annum. Okay, so the Sharpe ratio is very simply calculated by taking the annual return, average return, minus the average return on the benchmark investment. So from our first one, it's 10% minus 3%, and dividing that by the standard deviation of returns on our investment less the standard deviation of the returns on the benchmark investment, which is 5% minus 1% in our first investment case, which gives us a Sharpe ratio of 1.75. Now the other investment, which is more risky, more volatile, yields a Sharpe ratio of 0.5. Okay, so the rule here is that the higher the Sharpe ratio, the better the return in terms of volatility. So this provides a way for investors to make choices between one or more investments. And you see these widely published for all sorts of investments, stock exchanges, treasury bonds, commodity indices, and even electricity futures in the case of Germany, for example. So that means that we can go into the literature and actually extract Sharpe ratios which we can use to compare with the Sharpe ratios that we calculated for electricity futures in New Zealand. So the question here is, are the deltas that we've observed in the New Zealand electricity futures market excessive or otherwise relative to other markets once we take into account the volatility of the futures prices? And we're particularly interested in the perspective of an investor that might be interested in coming into the New Zealand electricity futures market and saying, well, I can see positive deltas here in some quarters, I can see negative deltas in other quarters, gee, I might like to do some trading and make some money. So just how attractive does the electricity futures market look to those hypothetical investors? There are some limitations with this analysis. The pure Sharpe ratios, as they were published by William Sharpe back in 1979 or whatever, assume normally distributed underlying data, which is obviously a problem for electricity. And I thought I heard a laugh there. It also assumes the market is liquid, which obviously is another problem. So if you've got data which isn't normally distributed and you're working with a market that's not particularly liquid, then the Sharpe ratios tend to come out lower if you correct for those factors. Okay, so if anything, we might be overestimating the Sharpe ratios by using that normal distribution assumption. But we have managed to correct for that when we looked at the Australian futures market by calculating what are called modified Sharpe ratios, and they allow for the distribution of returns from futures being non-normal. Specifically, they allow for something the statisticians call skew, which means that it's not a perfectly symmetrical distribution around the mean, so it's moved away from a bell curve, it's been given a kick sideways, and kurtosis, which means that the distribution might be more or less peaked than the standard normal distribution. So we've managed to calculate those for the Australian futures market and the New Zealand electricity futures market. Now I need to be quite clear about what these Sharpe ratios actually represent. In order to apply a Sharpe ratio, you need to have an investment strategy. And electricity futures on their own are highly leveraged, and you could think of them as being a zero or almost zero investment strategy, which actually doesn't work for Sharpe ratios. So what you have to do is you have to add in some collateral. which we've set, is typically set at the face value of the contracts. So in other words, assume that the futures the average spot price turns out at zero. What's the value of the contract if you hold it to expiry? So what we're saying that our investment is buying or selling a futures contract in a quarter, along with making an investment at a risk-free rate in an amount of capital that we put aside as collateral to meet our margin calls on that futures contract. So the total return that we're calculating has to include the return on that collateral, which is a relatively low return, I'd have to say. The other thing is that we constructed strategies for each quarter, which we've called a roll strategy. So that meant that the investor started purchasing futures contracts right from the start of the market, and every time their futures contract expired, then they automatically went out and either bought or sold, whichever was relevant, the same quarter. So we're rolling through buying or selling Q1, separately Q2, separately Q3, separately Q4. So that's what we're calling a roll strategy. And the period that we chose for the roll was 12 months. So we said that every 12 months the futures purchases or sales will be rolled forward. And sorry, I'll correct myself there. We were focused on the last 12 months of that roll strategy. And the reason for that is, just looking at the slides, most of the movement or the elimination of deltas, if you like, in the futures prices occurred in the last 12 months. So there is some change in the futures price obviously before that, but most of it takes place in the last 12 months. And that's a particularly convenient time step to use. Okay, so having done that, constructed those roll strategies for each quarter, we calculated Sharpe ratios, and we did exactly the same thing for exactly the same period, so July 2009 onwards for the Australian futures market, which trades in New South Wales, Queensland, Victoria and South Australia. And we also calculated the modified Sharpe ratios for those same quarters, the same futures markets. So the first point to note here is that the modified Sharpe ratios were lower than the Sharpe ratios in all but one case, and that was New South Wales Q2. So that's consistent with what the literature tells us, that generally when you take into account non-normal distributions and lack of liquidity, you'll get lower Sharpe ratios. So in other words, the investments in futures look less attractive than they might otherwise. Now this table shows for each quarter, in the green is the highest Sharpe ratio, or the lowest in red. Now when we talk about deltas and premiums, we tend to think of futures prices being higher than expected spot prices. In actual fact, we're seeing quarters where we're getting negative deltas, which means that futures prices have been consistently lower than spot prices, particularly in Q4 and Q1, which I've already mentioned. So particularly in Q1, both Otahu and Benmore. Now, given that investors would be interested in trading on positive or negative deltas, what I've done next is to take the average across the 4 quarters on an absolute value basis. So I've said, well, a negative delta is just as good for an investor as a positive delta. So we can get an absolute value average, second bottom row in each table. So 0.141 for the Sharpe ratios, for example, at Benmore. And I've done the same in the modified Sharpe ratio table. And then I've ranked each of those markets based on that average over all of the absolute values. So just looking at the Sharpe ratios, without taking account of non-normal distributed data, Otahu ranks number 1, just ahead of New South Wales, and it ranks number 1 because of negative deltas, not because of positive deltas. Okay. Number 2 is New South Wales, and it's got mainly positive deltas, although there's one small negative one there. And then back down to Benmore, which ranks number 3. And you can see that Benmore's got the highest Q3 Sharpe ratio, and as we discussed before, that is probably a result of these inflows that haven't happened yet being reflected through into futures prices. We see a pretty similar pattern if we use the modified Sharpe ratios, which is probably the better one to focus on since we're able to compare modified Sharpe ratios for both New Zealand and Australia. And then Otahu drops down to a ranking of number 2, again because of negative deltas, not because of positive deltas, and Benmore remains at 4. Okay, so what we took out of this was that, well, if you're looking at Sharpe ratios, how attractive are New Zealand and Australian futures to invest in, accounting for volatility in futures prices, then New Zealand doesn't really stand out as being more attractive than Australia. Okay, you might pick out Otahu, for example, because of negative deltas. And just remember, this is historical analysis we're looking at here, so you'd have to be confident that the negative deltas were going to persist into the future. And if it were me, I wouldn't be confident of that for Q1, but I might be for Q4. But you might pick out Otahu if you're going to trade on negative deltas. If you're looking to trade on positive deltas, you might be more attracted to New South Wales or perhaps Victoria in Australia. And when you look at the Sharpe ratios from other markets as well, which I haven't got on the slide, but which are in the report, New Zealand electricity futures don't stand out as being particularly attractive there either. Now finally, just looking at the international literature that was available for the Nord pool, there's a lot of analysis that's been done there, consistently positive deltas, up to 21% in one paper, but also for the Dutch futures market, Belgian, German and Australia's. And what we're seeing is that these studies generally find significant premiums and they tend to be positive. There are negative premiums there, but they tend to be positive. So electricity futures markets tend to be in what the futurists call contango. So that's consistent with what we observe in New Zealand. So I guess we're saying that New Zealand futures, if you allow for volatility in particular, are pretty typical of electricity futures markets around the world.
Joining the meeting.
Okay, so just to quickly close off, we're certainly not making any judgments on whether deltas are good or bad. Arguably, the presence of some deltas in the electricity futures might attract investors, speculators and others into the futures market, which will create liquidity, which can have benefits for the hedge market in general. We're certainly seeing that hedge prices respond in general to changing expectations. I mentioned before that big change which occurred in 2012 with falling or flat demand, and expectations around spot prices generally fell in the market, and the futures prices across the forward curve fell by $15 to $20. So deltas or not, expected spot prices are coming through to a large extent in the futures prices. I think we can be fairly certain if there was more liquidity, then we would see lower deltas. We did some work trying to sort of establish a range, but probably down to around about the plus or minus 5%. Some could be remain negative, some could be positive. We're certainly seeing that they tend to be positive on average, and particularly in Q2 and Q3, and particularly in the South Island, which suggests that some of these deltas are risk premiums. In other words, hedge buyers, futures buyers are prepared to pay a premium in order to avoid taking the risk. Q4 is looking like it's got negative deltas at the moment. And we've got a theory on this. It could be just less demand for a less risky period of the year, or it could be that hedge sellers are keen to offset any positive deltas in other quarters by accepting negative deltas in Q4 in order to keep the average value for each year in the forward curve down. And just to repeat what I've said a number of times already, whether you like these deltas or not, risk premiums or whatever they are, they don't seem to stand out against other electricity futures markets, Australia in particular, or other commodity markets. Thanks, John.
So very good, thank you very much, Greg. So it's pretty heavy stuff, really, but fortunately we have a bit of time where people can ask questions of Greg. Now the logistics of this might be quite challenging, so what I'd like to suggest is people try and ask a question. If you find you're talking over the top of someone else on the phone, then maybe let them ask their question and have another go later, and we'll repeat the question so that everybody has a chance to hear it. But just for the stage management of this, I think I'll probably flush the questions out in the room that we're in first, and then I'll go to people on the phone and on the webinar. So if you could also just explain who you are and where you come from before you ask your question, that would be very helpful so that people can discount appropriately and provide a delta on whatever the question you ask is. So have we got any questions in Wellington before we go global? Tim Street, Senior Advisor, Wholesale Markets for the Electricity Authority, has a question. I would have thought you've asked every question you could possibly have about this. Can you repeat the question first?
Sorry, Steve, can I just add to that? So does an efficient delta mean that the futures price is a inverted commas pure expectation of the final price? Is that what it's trying to back solve for?
Okay, so I think there's two questions here. The first from Tim Street was around what an efficient delta or risk premium might actually be in terms of percentages. And the second question from Steve Gorn, I think, was, does a delta of zero mean that the market is working efficiently, effectively? Have I got that right, Steve? Okay. So it's probably easy to deal with the second question first. And I'll just repeat one thing I said, that there's no theory that I'm aware of that allows you to sit down with your calculator and work out what an efficient premium would be. So an efficient premium could be zero deltas across the market, but it could also be positive and negative percentage deltas across the market. I don't think there's any rule of thumb or rule of law or rule of physics or finance that says exactly what that efficient level would be. Ultimately, it would be determined by the market and all those factors that I mentioned before. We did some, I'll call it theoretical work, looking at the cost of providing hedge cover in the South Island. We looked at what, based on our scenario modelling, a delta might be in order to provide a pure investor with a return which gave a Sharpe ratio of 1. One thing I didn't mention during my slides was that on an annual return basis, a Sharpe ratio of 1 would generally be considered good. 2 would be considered very good, and any higher than that, exceptional. In our literature review, we didn't really find any Sharpe ratios that got to 1, or if they did, they were only just over 1. So my thinking is that 1 might be a little generous to be on the good side. But when we did that analysis, we came up with a number of around about 5%. Remember that 5% can be either way, it can be positive or negative. So there's one back of the envelope almost method of calculating what might be an efficient delta on the assumption that it would be enough to attract investors into the electricity futures market. Okay. Now, one of the questions we asked ourselves all through this exercise was, well, okay, we've got deltas which can be quite large. If they're so large even allowing for the volatility, why don't we have a lot more speculators and investors in the market now? So the rather pessimistic conclusion from that might be that the deltas are already efficient. So yeah, I know I haven't answered the question, and I don't think you can answer it. Maybe the only other thing that I can add is that if the market was highly liquid with only hedges in it and very few speculators, I guess it's conceivable that the deltas could disappear altogether, at least on average. If both buyers and sellers, physical buyers and sellers, were relatively small and numerous, I think the futures market might approach that sort of theoretical ideal of representing expected spot price with no deltas and no premiums. Does that answer the questions?
Right, have we got any other Wellington questions? Further evidence of the intellectual decline of Wellington and the rise of provincial New Zealand. Right, let's see this week's blog on Energy News for more details on that. Right, have we got anybody on the phone or on the internet who would like to ask a question? Take a moment for people to unmute themselves. So, clear as crystal. Excellent. Well, there'll be a short exam that we'll be doing later on. There's a couple of deliberate errors that Greg's included in his analysis, so there'll be a chocolate fish for anyone who manages to find those. Just checking there's nobody who's muted themselves who's desperately trying to ask a question without success. Right. Last chance saloon. Okay, Richard, can you get my slides back? Oh, sure.
I'll ask one if I may, please. So this was a point in time in July. The futures market is moving and developing quite quickly. At the same time, and volumes are increasing all the time. So do you feel that these premiums have been tracking through time and towards your efficient level from where they first started from? So has there been a transition, has there been a dynamic movement of the premiums over the last 3 years?
Sorry, what's the question from?
Sorry, I'm Julian McCree at Genesis.
Yep. So question from Julian McCree at Genesis. Have the premiums, deltas or premiums in futures prices been tracking towards more efficient levels over time? That's a very good question. And one of the things that makes it hard to answer is that the market changes over time, as evidenced in 2012. My thoughts on the matter is that certainly since July, and probably since around about July 2013, they haven't changed much. And to be honest, I wouldn't expect them to change that much until we get more liquidity in the market. And I'm only saying that because it's like all other things being equal. There's nothing that sort of stands out as about to create a change or having created a change in the relatively recent past. But something could change tomorrow. We might read about it on Energy News tonight, which could potentially change that. I'm not making any hints, by the way.
Very good. Right, we've got anyone else on the phone or the internet who would like to?
John,
Yep. Alan.
John, sorry, it's Alan Irons here, New Zealand Steel. Can I ask Greg a question? Greg, you've outlined how 5% delta might be attractive to investors, but from a user's perspective, that just seems to be an added insurance premium for us to pay if we hedge. How does this all turn out to be good news for users?
So the question from Alan Eyes is plus or minus 5% might still attract investors, but not not necessarily good for industrial consumers as an insurance premium against spot prices. So yeah, how does the analysis help large consumers? And I guess my only comment on that is that, well, if you don't like the premium in the futures prices or hedge prices in general, if it was me, I'd be looking to go more on the spot market and making the trade-off via or between risk and cost in the case of a large consumer. If there was a movement in that direction across the market, then that would reduce the demand for hedges in general, which, all other things being equal, I'd expect to lead to lower deltas. So there's a bit of supply and demand going on there. At the risk of complicating things, and this wasn't mentioned in the report, if you look into the far future and start thinking about 90% renewables, and we've just done some other modelling on this, then it's quite conceivable that the gap between futures and hedge prices could widen significantly. And the reason for that would simply be that with more and more renewables base loading and being on the margin and setting very low prices, we could have long periods with very low prices and dispersed with shorter periods with very high prices. So I thought I'd just throw that in because thinking about the evolution of the market, I think we need to be always conscious that things can change. So deltas can come and go, market conditions can change, and what might seem like large deltas now could turn out to be quite small in future, or conceivably vice versa.
Is that good enough for you, Alan?
Yeah, I think that obviously gives the Wholesale Advisory Group further things to think about in terms of what is the purpose of the market, and particularly if the hedge market develops along the way we would expect of other futures markets where there's less real trading and more investor trading. It just raises that whole question, what's the purpose of developing the hedge market if it's not to actually provide a more competitive electricity market for those who live by it day to day, as opposed to going to it from a purely investment point of view.
Great, thanks. We have the Executive Director of the Major Energy Users Group who would like to ask a question. Ralph.
More just a comment, Greg. I think your observation that as we have more renewables in the mix, that potentially the delta might get bigger. I think that's sort of one scenario, but the market also is quite adaptable. We might actually see the cap products, for example, come into play, and therefore I think it's a market dynamic, very hard to tell which way the deltas might go. Just an observation.
Yeah, I think that's absolutely right, and it just sort of adds to this general sense that it is a dynamic market, and it is and should be changing as the market matures. Actually, I just thought on Alan's particular question, certainly from our point of view, I can go back to that briefly. From our point of view, Q4 looks quite attractive in terms of a negative delta. So again, if I was a large consumer, I would be looking to perhaps buy more of that particular product. So just sort of fleshing that hedging strategy out a little bit more, maybe backing off on Q2, Q3, accepting a bit more spot risk in return for a margin, and maybe ramping up on Q4 when you might otherwise not be hedging.
But none of this constitutes advice, and you're on your own. Did we put the weasel words in the discussion paper? We definitely said we were going to. Yeah, so see the weasel words for more details on how risky that might be. Right, anyone else on the phone want to ask Greg Size any questions about his analysis before we go back to the discussion paper? Tim Street again, value for money.
and stock prices and things, and in one which you sort of might list it. But do you have a gut feeling about the deltas in the over-the-counter market versus the futures market? Like, do you think if someone shifted from dealing bilaterally trading exchange trading products to on average purchase at a lower price, you're able to about the same level?
Yep. So the question from Tim is around the deltas in OTC product relative to the deltas observed in the futures market. And I think the answer is that, as some of you will know, that we calculate indices for OTC product, fixed price, variable volume, and CFDs. We also calculate the 3-year average futures price and reference that to Haywood's, where all of our indices are referenced, and the margin or the spread between the futures prices referred to Haywood's and the CFD index referred to Haywood's has been up to around 3%. It seems to have narrowed recently. So certainly, if you're looking at baseload product, then we would say that the deltas work out about the same, whether you're going futures or baseload CFD product at the moment.
Very good. Any more? Any more in Wellington? Any more not in Wellington? Or indeed in Wellington on the phone? Right, so move on. Thank you very much, Greg, and appreciate if you just want to stay where you are for now. That's okay. So just to continue stepping through my material to sort of unpack what we've got, and then we'll have an opportunity for questions about the WAGS paper, which Alan Eyes will answer, and I will absent myself for. Just to give you a guided tour of what's in the paper, as I say, there's a reasonably detailed, it's not a transcript, but a set of bullets summarizing the feedback from the presenters that we had. I think we had something like 7 or 8 different presentations of half an hour each over the 6 months that we've been looking at this. Also, considerably more data from the hedge market questions in the Electricity Authority participant survey, and considerably more detail on the analysis that we've presented some summary conclusions for. We've put up some hypothetical cases for further development of hedge markets, but with predictable caveats around the perils of unintended consequences, which is a consistent theme with the Wholesale Advisory Group, I would say, and indicated some preferences for incremental change rather than radical change because of that. And as I say, we've drawn out some of the underlying factors which will ultimately lead us to a clear problem definition and any recommendations about that. And as I say, the main 3 elements that we've identified are price risks, in particular the work that EnergyLink have done, problems around vertical integration, and funky stuff to do with behavioral economics, because we're really cool. And then we've suggested some potential development initiatives. That's slightly poor process, I know. John Carnegie, even though he's in Peru, can be heard shouting and screaming that we haven't clarified a problem definition, so how can we possibly have any recommended options? But given that we're only doing 1 discussion paper, we thought we might as well try and flush people out on what options they think are appropriate for the issues and problems that they identify. And obviously there's heaps more detail in the appendices. Now, I can give you a sneak preview of what may be in the WAG's final recommendations paper to the board, and these are the things that strike us as being blindingly obvious. So the first one is really around removing barriers, and these are the nudges that I'm talking about. So it is very clear that there are some real issues around understanding of hedge markets and the options that are available both to consumers but also to financial market participants. And a simple education program might actually deliver some real benefits given how concentrated participation in these markets are. You wouldn't have to educate hundreds of thousands of people. You just need to educate a few dozen really influential people. The second initiative where we are hoping to plagiarize the work that the Australians are doing is looking at mechanisms by which participants could offset their credentials for the spot market against some of their trades in the hedge market. And if you're a regular reader of the WAG's work, you would know that we've identified that credentials are an enormous barrier to entry for new entrants in particular. So anything that could be done to remove or reduce credential requirements for market participation would be expected to increase the number of participants and ultimately the level of activity. And the third thing, which is well underway actually, is ASX are already proposing to reduce the unit size for participation in the ASX electricity futures market. I think that's actually going to happen, isn't it? I think that's, when we started this was a really good idea. Shows how slowly we move. They've had 3 user group meetings, I think, proposed it, and it's all going to happen in January or February, I think. I can't remember quite when it starts trading. So our silent influence is obvious in the evolution of that. And as it says, some of these changes are already underway. So that stuff is pretty uncontroversial. That's not true for some of the other stuff in the paper, and we've done our best to represent the submissions that we've had from the people who've already made cases to us. One of the quite loudly made assertions that we've had from some parties is that hedge prices are restrictive. And so this does raise the obvious question of, well, if there's a problem with the hedge prices, then there's an arbitrage opportunity, and if there's an arbitrage opportunity, then why isn't that being taken? And we'd be quite interested to hear from people, particularly the people who hold these opinions very strongly, why they feel that these inefficiencies aren't being arbitraged away. And the other very nuanced issue is quite what interpretations to put on the analysis that Greg has presented us. It's clearly driven by a great deal of assumptions, and you can pick every single one of them apart, and the past won't necessarily dictate how the future will turn out. So the question then is, well, does it tell us anything about the design and operation of these markets, or is it just an interesting footnote to history as we are at the moment? So again, quite interested to hear what people think about that. Now, moving away from price, liquidity is a very difficult area to draw too many conclusions from. But in the paper, we do present some evidence around the extremely sensitive, what would you say, sort of performance of the ASX price to a very small number of trades. So the chart there shows the percentage changes in price influenced by a number of trades. So 96% of the time price movements are within 5% of the initial price, but there are some outside that distribution which are really quite material. So I suppose the area we're very interested in hearing from submitters on is just how material they consider liquidity issues to be, and I suppose most relevantly, what the extent of the effect of vertical integration on liquidity is in the light of that. And then the final area really is around barriers. There's a particularly loudly spoken and rather influential economist in the Electricity Authority who is quite interested to know what's preventing greater participation by speculators and intermediaries. The economist's view would be, well, if there's any inefficiency, just give it a bit of time and some information and it'll all get traded away. And then I suppose the other question is, well, what could we do to help facilitate that? We've talked a little bit about education, but it would be very helpful to know who we should be educating, how we should be educating them, and I suppose what we should be educating them in. Whether there are options which are technically feasible for more efficient trading of hedge market products. Obviously, there are enormous opportunities to provide more information and more raw data, but the question there is what information and data, and in what form, what analysis would it be useful, and also in what medium would it be appropriate if you're really interested in increasing participant. Is it simply a question of promotion? One of the questions we've asked ourselves is whether the issues are a bit more basic than that, that some potential participants are simply unaware of some of the options that are open to them. That's rather more fundamental than education. That's just propaganda. Or do we need to do something a little more drastic? See the submissions of several of our earlier presenters for some ideas about just how drastic they would like the recommendations for the consultation to be. So just to summarize what we're after, we're really interested to hear. We've obviously already done quite a lot of talking to people all over the industry, both the people running the exchanges, people on both the buy and the sell side, and clearly the WAG members themselves bring a fair degree of expertise to this. Sorry, that's really patronising. Bring a high degree of expertise to this. And I should also say the authority and the Secretariat have done a really great job in boiling this down. I'm very grateful to them. You should have seen the third from final draft, which was probably about 3,500 pages of utterly incomprehensible gibberish. So I think to get it down to the crispness that it has is a great, really good job. And the purpose of the discussion paper is to flush more out from the industry. We're really not settled even on the problem definition at the moment, let alone what interventions we're going to be recommending to the board. And I guess in terms of the nature of feedback that you give us, the most useful thing would be if you can provide examples and evidence of whatever assertions you're making. I think we get the assertions. We've heard a lot of people telling us that life is really hard. What we need is evidence of whether intervention would be efficient. And remember again, the authority board are the people who make decisions about this, and they are under a statutory obligation to evaluate changes to market design in terms of competition, reliability and efficiency outcomes. So if you can provide any evidence that would help us prove or disprove that, then it'll probably mean that whatever recommendations we make will be more or less influential. A final observation, obviously we've given the stage to some people who we sort of shoulder tapped and asked them if they'd mind coming along. A couple of them sort of shoulder tapped us and were probably responsible for this being on our work programme in the first place. But it hasn't been exclusive by any means. And one of the observations is we haven't had a mainframe generator make a presentation. Obviously we've got 3 of them on the group, but it did strike me that the 2 who aren't on the group might be quite interested in coming along to tell their story. That's Contact and Mighty River Power. Don't need to be too sort of secret squirrel about this. But equally, if there are any other issues which you'd be interested in actually presenting to the WAG members so that we can have more of a conversation about it, then we'd welcome offers. And as we digest the results, we could then hear from people in our February and March meetings and still be consistent with the timelines that we're looking at to try and get back to the board. So that's sort of really what we're after. And the submissions don't have to be War and Peace. If there are just single issues that you're interested in being expressed on, or if you think there are areas which are poorly understood, just drawing our attention to that and some data sources would be extremely helpful. And there's a lot of stuff we could do. So just so you know what the sword of Damocles that's hanging over the industry is, we are considering the separation of generation and retail, which is a very constructive suggestion that has been put to us quite strongly. We're considering mandatory auctions, a cumulative price cap, compulsory market making, and an incentive scheme for market making. So if you don't help us write a really good recommendations paper to the board, those are the things that are going to go through the keeper. So that's quite draconian. I think it would be fair to say that there are some other things that are in lighter blue on the slide which are very likely to make it into our final recommendations paper, and these are the nudges that I'm talking about. So things like support workshops, publishing educational materials, providing information in new forms. One quite interesting suggestion is around supporting advisors, whether there's something you could do to oil the wheels of understanding by helping to sort of get people out there working with potential participants by improving their knowledge, but as sort of intermediaries rather than expecting the end participants to do it themselves. And one area that's quite topical this week, which somebody pointed out to me earlier on this morning, is there is a passing comment in the paper about the interplay between the gas futures market and the electricity futures market, and I do wonder, given what was happening earlier this week, whether we really understand what's going on here. So again, I'd be quite interested to hear from anyone who has a view about the link between the two, and whether there may actually be some developments in the gas futures market which may have implications for the participation in the electricity futures market. So again, if you've got any views about that, that'd be pretty interesting. And last but not least, as well as leading the Electricity Authority in its use of multimedia, the internet and teleconferences, the Wholesale Advisory Group is now world famous for having introduced its 5-dimensional bubble chart analysis of implementation options. This is a form which we sort of came up with when we were looking at pivotal pricing, and the idea is that by having bubbles whose size represents one thing and whose color represents another thing, and who are plotted against 2 axes, on one chart you can trade off 4 different variables. And so that's what we're trying to do with the bubble charts, and it has worked incredibly well for us in the past, where we had many options that are different in quite subtly different ways. Unfortunately, we came up with 5 different parameters that we wanted to trade off this time. So we thought the way to do that was to have 2 different bubble charts, but to change one of the axes. So that's the reason that there are 2 apparently identical but different bubble charts in the
Joining the meeting.
Somebody's joined to compliment us on the brilliance of the bubble chart. So that's just a point of clarification. We think it works quite well. It's not meant to make things sort of difficult to understand. But the health warning around the data in the bubble charts in the discussion paper is this was based on limited Delphi analysis. So Delphi analysis is where you go out and you ask a bunch of experts what they think. Limited Delphi analysis is where you make it up and talk to one expert. So this consisted of the Secretariat strapping me to a chair and asking me what I thought. So the rankings are pretty controversial, I would say. So again, we're quite interested in what the right rankings ought to be, but it's quite likely we'll use an assessment framework like this as a way of justifying whatever recommendations we come up with later on. And just to summarize the sort of logistics of this, unlike quite a lot of other people in the electricity industry, the Wholesale Advisory Group's really nice. So we finish our consultation period, sorry, it's not consultation, is it discussion period, before Christmas. So we're not very nice to the Secretariat, who will have to digest all of this stuff over the summer holidays, but we're looking to get people's submissions on the discussion paper by next Friday, the 19th of December. So the good news is that if you've realized that you haven't done anything about this, you do actually have a week and a half to get something in. And given what I'm saying about targeting your input on issues that are really material and trying to back it up with some data, that's probably enough time, which is one of the reasons we thought we'd do this today. You just need to email it to the WAG email address, which is wag@ea.gov.nz. And we'll consider anyone's submissions, even if they're completely ridiculous. We've already had a few that were pretty out there, so that's pretty good. And we're targeting Q2 to report to the Electricity Authority Board. We've been pretty clear with the board that given how poor the problem definition that they gave us in the first place was, we probably reserve the right to take as long as we feel is appropriate to come to a conclusion on this. So if we unearth some really surprising new areas, we may commission some further analysis, and I think if we do that, we haven't got a snowball's chance in hell of doing this, so it'll probably be a bit later in the year, but we'll see how we track. The final thing before we get to questions, I think we'd be quite interested to know how this format of information sharing session goes. The authority guys quite liked the idea that we should work a bit harder at making our discussion papers easier to understand. So it's possible the authority might choose to do this with the Retail Advisory Group on some of its discussions, and possibly even on some of its own consultations, because although Wellington is a really groovy place, I do appreciate that not everyone wants to come here all the time. So if there's any, even if it's technical stuff about I couldn't hear things or I couldn't see the slides or something like that, just email the WAG email address and Sam will be delighted to get your feedback and distill it for us. So that's the end of the presentation bit of this, but I did want to give you an opportunity to ask any questions about the discussion paper or even the investigation more widely, and I think I'll do that the same way I called for questions on Greg's paper. So we'll start off by seeing if there's anyone in the room in Wellington who wants to make a comment or ask a question. Ralph.
Just a process question, John. Just echoing what Alan I said, this is a very, very important issue. I mean, I'd take with a grain of salt the 5% delta that we calculated, but even if it was half that, it's still a substantial amount of money. I'm just wondering whether WAG could entertain a cross-submission phase, because I think we are interested in what the large generators might have to say, for example, and other parties. Equally, we're quite open to have our submission critiqued by other parties. So a short 2-week cross-submission first quarter next year.
Yeah, yeah. No, that's a really, so the question that Ralph, who is the executive director of the major electricity energy users group, which of the two are you? Gas is on the margin. So the question that Ralph's asking is whether or not, as part of WAG's process, we might have a set of cross-submissions or invite cross-submissions and digest those before we conclude our investigation. There's absolutely no reason for us not to. And one of the things I've enjoyed enormously is discovering that we're not bound to any process. So it's really up to us how we decide to do things, provided that we manage the board's expectations. But I think that's entirely consistent with, depending on what we find, tailoring our path. The one thing that will be true, though, is almost regardless of what we submit to the authority board on, they will almost certainly call for cross-submissions through the fact that they'll be consulting on the recommendations. So if we decide not to, you could still refer back to the submissions people make to us when you're submitting on the authorities consultation process. And I think there is a trade-off between latency and completeness here, that one of the slightly frustrating things about the way we work, the WAG only meets every couple of months. Every time we add an extra step to the process, it adds 6 months to our timeline, and sometimes the balance of opinion on the group is that it's better just to keep things moving, get our recommendations up to the authority board, and then we drop into their bureaucratic process. But it's not exactly Quicksilver the way that this goes. So, but it's a very constructive suggestion, Ralph. I think we'll just see what we think of what we get back. Yeah, any other questions, comments in Wellington? Intellectual vacuum continues. How about on the phone or on the internet? Anyone got anything they'd like to ask about? Right, mandatory separation of generation and retail. Oh, hang on, say that again.
Yes, Stuart Innes here from EMH Trade. I was just wondering if the authority might take the opportunity to give the group an update on some of the parallel initiatives that I understand are being progressed, like market making agreements and things like that.
So Stuart Innes from EMH Trade is asking whether or not the authority would like to provide an update on some of the things that it's doing in parallel with this. As you're probably aware, the authority itself, with absent the WAG, is currently talking to the existing and potential future market makers for ASX products about market making for some alternative products. Now, we did get a brief update on this in the Wholesale Advisory Group meeting 2 weeks ago, the minutes for which aren't out yet. So, Stuart, that's probably the obvious place. Do you actually want somebody to say something now on the phone? I mean, that's probably not inappropriate. Tim, are you comfortable? Do you want to come up here and sit in my seat? That would be... but you need the microphone and you need to sit in front of the thing. So I'll sit there and you sit there.
Well, there's a seat for you. Thanks, John. So I guess the Hedge work that's set out in the work program for 2014 and 15 splits into 3 key areas. There's the work of the WAG and the Secretariat's support of that work. There's the process by which I think it sets out that we'll sort of meet with the large generator and retailers in the industry and discuss perhaps extending market making in some form or other. And then the third one is about the issue that you've already identified, or not the issue, the possible benefit of having futures markets offset spot market prudential requirements. Perhaps, obviously, the WAG one is the topic of discussion here now. So the other two, I'll just briefly go over those. Perhaps I'll start with the futures offsetting spot market requirements. I know that NZX are giving that some consideration as the clearing manager about how that might operate, and in fact they're going to sort of do a high-level think piece and provide that to the authority on options around that. I don't think it's necessarily straightforward, and we've already had some meetings on how that might work. The other interesting development is that there's a combined design study by AEMO and ASX. So AEMO is the market operator in the Australian electricity market. And they're originally targeting a design study to be published near the end of this calendar year, but I think that's now been pushed out early into the new year. I see some similarities here with the previous WAG work on the settlement and prudential security area, is that we had AEMO come out and sort of provide some information on their recent work, and it was a real way to kickstart the WAG's consideration at the time. Again, there's the real possibility that this design study conducted in Australia could actually provide some really useful advice to the authority and the industry on how it might be able to be achieved. Basically, we could steal some of their ideas. Their alternative is that in some discussions of ASX, and this would have to be followed up with AEMO, but there's the possibility that New Zealand could be treated more as the test case in advance of it going live in Australia. But so that's what the work sort of involves there. I have to say, when we have a discussion, it starts out that it's an obvious thing that can be done, but it isn't as straightforward as what you might first think. Previous work in Australia has generated volumes of material on it, and they haven't quite cracked it yet. So I'm hopeful something will be able to be achieved, but it's not a sure thing. The one around market making, that is one in which the authority decided to sort of progress that work in sort of parallel or in tandem with the WAG work. I guess one of the reasons for that was, I guess if discussions are to be held, the board felt it was more appropriate that authority staff do that with parties in the industry. The second one was around timing. Perhaps that could be done a bit quicker. As it turns out, the timing around that is likely that those discussions sort of in more detail are likely to happen in the new year. What has occurred to date is that the chief executive of the authority and myself had meetings with each of the big 6 generator retailers, so that includes Nova in that mix, and Trustpower, Mighty River, Genesis, Meridian, and which one have I for Contact? Sorry. And we've summarised those meetings, and we're just about to finalise those with the parties. I think another factor that's occurred is there was an ASX user group meeting a month or 2 ago, I think, and that was quite a really useful meeting. There was some really good feedback from people who attended that if new products are going to be added, they have to be designed in a way that are actually useful for parties to trade. And I think the challenge through to ASX and the authority was to more clearly identify what those products would be. So particularly around a cap product, the authority has expressed an interest in the fact that it thinks that if a cap was added, a fixed price cap that is, that it would be of value. And the group, I guess, kind of challenged the strike price that was suggested by ASX. So we've already had a really useful meeting with MEUG, and we plan to catch up with some of the smaller retailers and some of the other parties in the industry to ask them questions. But it's not just about the cap, it's to ask them more generally, what barriers do you consider there are to getting involved in trading in futures? So I guess any feedback there we'll share with WAG, and we'll sort of combine the thinking together so it well integrates. But I think we didn't want the meeting just to discuss cap. We want to understand more generally about parties' experience in trading or not trading futures and options and build on that. So the plan will be is to summarise all that and provide it to the ASX user group meeting in advance of it taking place in February of next year, and then have a bit more interaction about the value of what products could be added. I guess my takeaway, and this is just my own personal one, is that there's value in just having a cap trading, and then, or there could be value in having a cap trading or new products trading, and then there could be additional value in market making those products. But those two aren't necessarily interlinked. So or have to coincide from day one. Yeah, so that's a bit of an update. So I guess for those larger generator retailers that we contacted, they're most likely going to be contacted in detail again early in the new year. And the authority plans to release a paper to explain how those discussions went and what it might do. So everybody will get an update on that shortly thereafter. I can't say for exact, but I expect it to be about March, perhaps of next year, time to produce that.
Cool. Thanks, Tim. Does that answer your question enough, Stuart? Deafening silence, I assume so. Right, anyone else on the phone or on the internet who would like to ask a question, make a comment about the wider hedge market investigation that the WAG is conducting? Right, I'll just hand the microphone back to Greg Size, who just wanted to make one clarification on his stuff.
Yeah, this just sprang to mind with mention of the plus or minus 5%. Okay, we put a number in the report. Whether that's the right number or not is another matter, but that's quarter by quarter. So even if it's the right number, it could be -5, +5, +5, -5, which gives you an annual average of 0, or it could work out with an annual average of a negative delta. Don't just assume that it's +5 across all quarters or -5 across all quarters. That's me.
Very good. Thank you very much. Right, last call at the bar in Wellington.
Ben Garrison from Australia. One of the picking up on your comments, John, about problem definition. One thing noted in the discussion paper is the risk of current market makers withdrawing from voluntary arrangements. I guess I'd be interested in sort of the discussions at the WAG about how much that is a problem, that risk of voluntary market makers withdrawing versus future development of the hedge market. It seems to me that in many ways we might want to secure the gains that have actually been achieved to date before further development takes place.
So the questions from Ben Gerritsen at Castalia, the economics consultancy, and it's asking about whether the WAG has sort of discussed quite what future it would like to see for market making in hedge products, and whether there's a need to change that or whether it's just a question of trying to perpetuate what we currently have. I think it'd be fair to say we haven't really talked about that very much. I know that most of the discussions we've had about market making for hedge products has actually been in the context of the work that the authority is doing with the generators. And I know that one of the things that the authority is considering is whether it's necessary to have mandated market making, or it's more just a question of clarifying what incentives exist for market making and then reward market makers appropriately and charge those who benefit from it accordingly. And I think philosophically that's the sort of perspective that the WAG members have. They're all quite market friendly, really. But we haven't really talked about it in isolation, I'm afraid. Any more for any more? Right, anyone else on the phone or on the internet? In that case, can I thank you all very much? I might just make a passing comment before we wrap. So having explained this sort of creative tension that exists between the two advisory groups and the authority board, it may sound as though the advisory groups are quite lame. It's possibly not true. So a good example of this would be the investigation that we did into pivotal pricing last year, where I'm sure it's been minuted. Prior to us undertaking the work, the authority board's view was that it would be necessary to have death by codification, so an absolute ton of rules about everything that wasn't acceptable and nasty things happening to people who broke those rules. And We floated the idea of conduct provisions as possibly being a more dynamically efficient solution to this problem, and the board was not at all convinced of our initial suggestions. And it's as a result of the work that we did based on the feedback we got from the industry, where we demonstrated how conduct provisions would operate in the market and how the governance that we have under the current arrangements, in contrast to the Electricity Commission era and the self-governing arrangements of NZEM, would result in different incentives and different pressures, might lead to different outcomes from the outcomes we saw from conduct provisions under NZEM and Maria. And the Authority Board accepted those recommendations, and the conduct provisions that are now being codified are a direct result of the industry discussion that we had around Pivotal. So it's a very good example of just how influential this can be on some pretty profound issues. So I would encourage you to use this opportunity to try and help us make recommendations to the board that they will accept, because it could save you from mandatory separation of generation and retail and all these other lovely things which are just around the corner. Right, Merry Christmas. Thank you very much, Secretariat, for all your work, and we'll look forward to talking to you about something groovy next year. Not quite sure what we're doing next year yet.